And I'll also post a link to watch the recording later. So, welcome everybody. All right, people are trickling in. That's great. Got Lindsay in. Awesome. We were just chatting about expenses with Bridget, who works here in our School of Business offices. And we'll start on time. We got about 1 more minute to go. And I'm still sharing my screen. So I've got the matter of fact, let me see if I could have the chat box here on the side. There we go. AirPods on home for ear like it. Ha! The good old days, classic phone to the ear. That works. All right. I could put these side by side. There we go. There. Now I can actually see the chat box and the agenda. All right. Well, welcome to Moneymakers Club, streaming here live from the FinTech Center over at Kent Campus, and of course via the WebEx. So, for those of you that are here for the first time, welcome. Moneymakers is a student-driven investment club that's officially chartered here at FSCJ, and I am still the faculty sponsor so far, and until someone takes my place at some point. But what's really wonderful about this summer is that I'm working full time over the summer while I'm physically here in the States before I head out back on the road, being a digital nomad. So for the first time ever, we are having Moneymakers Club in the summer, which is great. So I'm glad to see you all, and I'm also glad to see your names. So I see my students here, and getting some extra credit and also some great information. So all the topics are chosen by students, and usually at the end of the meetings, I ask for some ideas for future meetings, and we have a topic that actually we hadn't talked about before, which is on high yield savings. So welcome. I'm Professor Velasco, of course, if you don't know, and I teach a whole bunch of different kinds of finance courses here at the club, at the college. And of course, I'm also an active investor and a trader as well. So I trade every day. And as a matter of fact, I was spending the morning managing several trades today, and I'll probably do some more trading in the afternoon after I grab some lunch after this meeting. So we'll go ahead and get started with what's going on in the market. And I always encourage everyone to what I consider being market aware. So taking a look from a macroeconomic point of view, and I always look at the news differently than most people. I can ignore politics and fluff and all that stuff, but if it's something that affects uh, or gives me ideas to make some money, then I'll pay a little more attention to it. Otherwise, I don't let it bother me. So to help you guys be market aware, I always like to have an agenda item talking about what are some things that are recent that could affect markets, which affects, of course, all the stocks that are out there. So at 8:30 this morning, the federal government came out with the Federal Reserve's preferred gauge of inflation, which is PCE. That's personal consumption expenditure. So what they're doing, basically, just in regular terms, is that they have a basket of goods that they track, and they're taking a look to see what people are actually spending. So personal consumption, household consumption, things like food and fuel and other types of expenses, or durable goods like appliances. And so they're taking a look, well, has the cost of just stuff that households spend on, has that gone up? And we know under this big backdrop of being in a war in the Middle East, that's caused a lot of things to go up. Uh, Not that we aren't already in a high inflation environment, but PCE came in at about 3.8%. So when you're taking a look at the cost of goods and services, it's gone up period over period 3.8%. So that is the state of inflation right now. What do we want inflation to be? Well, if you ask the Federal Reserve has a goal of about 2% inflation. So we're close to double that. As a matter of fact, it was closer to 3, but since the war in February, it's started creeping back up closer to 4. So the stock market's actually up today because the reading wasn't as bad as they thought it was going to be. So inflation month to month went up at about 0.4%, and they were expecting an inflationary increase of about 0.5%. So a little better than expected. So markets are kind of breathing a sigh of relief, which is why they were down this morning, but now they're back up since the report. So I'm taking advantage of that. And one nice thing about looking at the markets is that you can make money whether stocks go up, down, or sideways. You just have to know what strategy applies. Another big thing that you want to be aware of is the end of earnings season. Every quarter, so after March, after June, after September, for example, after December, usually within the month after that, companies come out with their quarterly accounting statements and they reveal whether they made money or not. How good was their revenue? How good was their income? So the end of earnings season has been going on since April, and we're kind of on the tail end of that. We just got like just a handful of reports left, but the bulk of the companies that have reported earnings have actually done really well. There's an expectation for a certain amount of revenue. There's an expectation for a certain amount of profits, and the companies reporting have exceeded those numbers. What I always find interesting is that you have companies that have uh, better than expected earnings, better than expected revenues, and a lot of times you see the stock drop often. And then you see a company that had a loss, but then the stock goes up a few percent. So it's kind of interesting to see that the price of the stock doesn't go the direction that you would expect it to, despite the news. If you take a look at one of my favorite stocks, Nvidia, they just announced their quarterly earnings just in recent weeks, and the stock was like in the 220s, and now it's all the way down in the two teens. And yet they had way better than expected income. They had way better than expected revenues, better than analysts expected, and the stock still dropped. Is it profit taking? Probably. Is it a fear that stocks that have anything to do with AI they think are inflated? That could also be true too, because there's a human element involved that it's sometimes a little more challenging to see outside of the numbers when you're taking a look at stocks. Another big thing, the biggest stock news this year in 2026, it has to be chips. And I'm actually going to write right here in the agenda just to give you an idea. So chips, I'm talking both memory chips and I'm also talking processing chips. If you've taken a look at stocks that have anything to do with memory chips or chips that power artificial intelligence, those stocks have actually exploded just this year. And I've taken advantage of some really good trades in chips like Micron Technology. or Taiwan Semiconductor. Of course, there's NVIDIA, but then we've got the hard drives. Hey, come on in. There's a sign-in sheet right on the back. So we're just talking about what's going on in the market right now, and in particular, we talked about earnings season. Right now, we're talking about chips is like the biggest thing this year with stocks. So, and got a lot of folks online, so that's why I'm not talking to myself. I'm talking to folks in here. So, microtechnology, Taiwan Semiconductor, of course, NVIDIA. But then what's really taken off is storage. So with artificial intelligence, you have all these big data banks of memory storage. And of course, they're building all these data centers all over the country to store uh, what is needed for artificial intelligence to work. So companies that have been kind of not really moving around now see them as the go-to stocks for memory, and they can't have enough orders filled. So we're talking about companies that have been around for a long time. We got Western Digital, we've got Seagate, we've got SanDisk, and I've bought hard drives that I carry around me with a variety of these big names. But just to show you how dramatic the chip trades have been for 2026, and should be able to see the screen. I'm going to expand this screen here for a minute. Matter of fact, let me put the chat box separately in a separate window so I could see you guys. There we go. Now I can see the chat box, and we will go to Yahoo Finance right here. So let me demonstrate on how dynamic anything that has to do with either memory chips or processing chips have done for 2026. Of course, you can look up CNBC. Yahoo Finance, I just find is very user friendly. So for those of you students that are doing the stock portfolios, or in my Fin 3400 class, this is a good spot to look at the numbers for your Chapter 2 assignment. So let's take a look at, there's a quote looked up. Let's take a look at some of these chip stocks. Let's look at the chip makers. And again, the first company ever to reach $5 trillion in value is NVIDIA, but companies like Taiwan Semiconductor and Micron Technologies. Taiwan Semiconductor, by the way, is one of the suppliers of chips to NVIDIA. But here's Micron. See, they're up $14 a share today. But if you take a look year to date, since, if it'll give me the year to date chart, there it is. How dramatic that is. We're talking about just since January 1st of this year. So they opened $295, and of course hindsight's 2020. And imagine if you bought shares of Micron for less than $300, and we're in May right now, and you would have more than tripled your money. It's pretty impressive, which is why I'm still trading that one bullishly. Again, the AI trade, is it overvalued? Maybe, but the thing is, you have to take a look at their earnings. Is earnings growing faster than the stock price relative to earnings? So if the earnings is growing that fast, then it actually is justifying the stock price. And that's what a lot of people don't seem to realize. Let's take a look at, look at this. Taiwan Semiconductors, one of the suppliers for AI chips. Let's take a look at their year to date.
Professor, I have a quick question.
Yeah, question.
Yeah, this is Mandy. Um, so like you said, like or when you see I want to ask about the number at the bottom when you roll down, right? So how you can like understand those numbers?
Okay. So are you talking about the numbers here on the side?
No, no, like the PE, the ratio. Oh yeah,
Oh,
yes,
here
yeah,
on
yeah.
the sheet
Uh-huh.
on the
Uh-huh.
summary sheet. So
Uh-huh.
the PE ratio, price to earnings ratio, basically that's the stock price divided by their earnings per share. And so the 36 means that people that are buying the stock of, in this case, Taiwan Semiconductor, are paying about 36 times what their earnings is. So, which means that they are considering, based on how high the stock has gone, they think that the stock uh, or the earnings is worth paying that many times more than than what other companies are paying for their earnings, or what other investors are paying for other companies' earnings. So again, this is also pretty dramatic. I mean, from 300 something bucks in January to 426. I mean, that's a really significant growth. That's like a 33% return in what,
So
5 6 months. So PE ratio is one thing you can compare to the stock market. So if the
mhm.
stock market has a PE ratio of like 25, meaning that people are willing to pay 25 times what the average earnings are of the stock market, that means the PE ratio of Taiwan Semiconductor is more expensive than the market. On the surface, it looks like it's a little overvalued, but really it might not be. And one thing that isn't on here is the growth rate. Okay, Florence has a question. What do you mean when you say you're going bullish on a stock? Great question. So, what I mean by bullish means that I have a thesis that I think the stock price is more likely to go up than it is to go down. That's what I mean by going bullish. And that comes from an image of like when a bull attacks you, it usually attacks with its horns going up to try to gore you with with its bulls. Bearish, it comes from an image where you take a bear claw, and when a bear attacks you, it just kind of swipes down at you. So that's where they kind of get the term bull and bear from. So bears assume that stock prices go down, and bulls assume that stock prices go up. So a lot of buyers of Taiwan Semiconductor, Nvidia. Let's take a look at the probably the biggest movers upwards for the price are probably the ones that have to do with memory. So let me take a look. I think let me look at SanDisk. Again, these they're known to make hard drives, but they've kind of expanded their market into artificial intelligence because of all these data centers that are being built all over the country to house artificial. Yeah, see, this is really dramatic to me. Uh, you take a look just this calendar year. You take a look, and again, I know the stocks look expensive, but you should never buy a stock or invest in a stock based on its price. Invest on it based on its quality. So I'd rather buy just one share of a stock that might not be that cheap, but I know I can sleep well at night, knowing that I'm not going to lose my money on a quality stock, versus say buying like 100 or 1,000 shares of a really cheap stock and then lose all your money because the company's crap. So SanDisk Corporation, I mean, it's my goodness, it's 6 times maybe what it was worth in January, and that's very powerful about the need for storage. So I'm not going to go through all the chip stocks, but just those industries in general. We're talking about chips, we're talking about memory. Those have been the big trades for 2026. And the thing is, has it overextended itself? Maybe. But if the earnings keep on increasing, then it's justifying the stock price. And so the fact that AI is kind of still in its infancy means that it might have some room to run. All right. So that's been the big thing. So we got again, inflation is a little lower than expected today, so the markets are kind of happy about that. Earnings season's wrapping up, but it'll be upon us before you know it. Uh, Next month is the end of the quarter, so come July we're going to have earnings come again, and so the question is, can these companies sustain their earnings uh, throughout the rest of the year? So now we got our suggested topic of the month. So this is one that actually we haven't done before, but since all the suggested topics are student driven, we had a student recently suggest uh, ideas for high yield savings. So if you want to save up some cash, where's a decent place to park your money so that way at least preserves the value of the dollar, but still gives you more bang for your buck at a higher interest rate that you can get from a regular savings account. You know, savings account, we put money in savings to preserve our cash. So that way, if we need cash within the next 12 months, we've got it, and it allows us to be liquid in case we need access to that cash. Now, I always tell my students, if you don't need an amount of cash for 12 months or more, then letting it sit in cash or in savings actually does you a disservice. And that's because of inflation. So if inflation's like, as we learned this morning, 3.8%, and your little savings account at your bank or your credit union is paying you 0.5% or 1%, then inflation is going to eat you alive. So your purchasing power for those dollars is going to be eroded very quickly. So at the very least, we need to be able to at least keep up with inflation or keep the purchasing power of that dollar. So for that cash that, like I have money in an emergency fund. So I'll keep like so many months of expenses in an emergency fund. So if in case something really bad happens and I lose the ability to earn income for a while, at least till I gain that back, I have the ability to pay expenses for a while. But with that cash sitting there, and me being me, I always rather have that money working for me as much as possible. But for that emergency cash, then I want to at least be working to beat inflation. So, what are some ways we could do that? So, a couple of things I came up with. I always make some handouts for these topics. So, I came up with a couple of good ideas to where you can at least beat inflation. So, one is high yield savings accounts, and there's multiple ways. High yield savings accounts, bond ETFs. There's money markets and CDs, and we've probably heard of money market accounts and CD accounts a lot, but I didn't include it in today's discussion because those are kind of restrictive. I mean, I have a money market account in my credit union, but I don't plan to touch that cash unless I'm paying bills. And the reason why money markets are restrictive is because there's actually a rule, I think a Regulation D rule, where you can only withdraw money, like move money or like have bills paid out of a money market account only 6 times per month, which is pretty restrictive, especially if you have a lot of bills to pay. So there's ways around that. You can physically go to the bank and transfer money to your checking account uh, out of there, and that way, and it doesn't count against the 6 movement restriction out of a money market. And then CDs, certificates of deposit, they usually tout a little higher interest rate than your little 1% or whatever in your savings account, but then they aren't really that much better. They're still pretty low. And worse, they are restricted based on time. So if you put money into, or you buy a CD at your bank, which they always advertise you to buy a lot often, um, might be 90 days, could be 6 months. And that money is stuck there, true, paying you interest. But if you need that money right away, then you actually have to pay a penalty to take money out before that 90 days or 6 months or whatever time for that certificate of deposit is up. So to me, that's kind of restrictive. want to have the access, but I also want to get the higher rate of savings. So those two were out for today's discussion. So high yield savings and bond ETFs are a couple of things that kind of get around that. So with high yield savings, you want to look for that little sticker that they're FDIC insured, meaning that the U.S. Treasury or the Federal Deposit Insurance Corporation will insure individual savings accounts up to $250,000. So in case the financial institution goes out of business, at least you're insured by the federal government. So if you are a high net worth individual and say, well, Professor, I got more than 250,000, can I get covered? Yeah, you sure can. Just split up the accounts. Just open up more than one account with 250,000 each, and you'll be okay. But I went ahead and researched some APYs that, and also made sure to look that they were all FDIC insured, which is important. That gave a little bit more bang for your buck than the small percentage in your savings account or money market account. So Santander, which is actually a really big bank in Europe that I've used in my travels, they have an APY or annual percentage yield, and that's something you want to look for, of 4%. So again, it does beat inflation, not too bad. But more importantly, when you're shopping around, look for ones that have low fees or zero fees. So Santander, they have a zero fee. They have a minimum balance of $500, but they are insured. So 500 minimum, so it might be a little high. The next three that I found are a little more attractive. So Axos, they have a savings account called the One savings account. So also a good, a solid interest rate, so 4.21, zero monthly fee, zero minimum balance. Sally Mae, so 3.75% APY, zero monthly fee, zero minimum balance. And of course, name brand, American Express. They have an HYSA or high yield savings account. Little lower interest rate, but still solid, 3.1%. It should keep up with inflation. Zero monthly fee. Their minimum balance is small. It's a doable entry point. Are these international banks? Sally Mae and American Express are American. Axos One, I'm not sure, and Santander, I think, is an international bank, but has a U.S. presence for FDIC insurance. So Axos One is the only one of the four that I wasn't as familiar with, but has the FDIC insurance. So again, do your due diligence and pick one, whether it's these four or ones that have similar features as these. And again, make sure to look for that FDIC designation too when you're shopping around for yield. So again, try to find the highest yield as possible, but also the ones that have that insurance, because you want to make sure nothing happens to your accounts. So yeah, great question. And then the alternate, which is actually what I do with most of my emergency funds, is that I actually stick them in bond ETFs, primarily for two reasons. One is yield, and two is liquidity, meaning that I have access to the funds whenever I want. So if I need the money, then I'll just sell the shares. So I'm sharing a couple that I'm in my emergency fund, and then another really solid company that a lot of you may have heard of for your retirement accounts. Vanguard is probably the biggest mutual fund company in the world, and I'll start with that one first. Even though I'm not in it, they have an ETF, and I'll step back. If you're not sure what an ETF is, what an ETF stands for, it's called Exchange Traded Fund. And so it's designed to track a particular investment strategy or index. And basically, these are just like mutual funds, and they're managed by managers, and they choose all the investments that go inside the fund. But unlike a mutual fund, you can actually buy and sell shares of these funds just like buying and selling shares of stock. So they have their own ticker symbols, and you can just buy and trade these shares. So BND, TBLL, PULS are all bond ETFs. So PULS and TBLL are very similar. BND, the investments in that fund are broader. So Vanguard, which again is probably the biggest mutual fund company, they have one called the Total Bond Market ETF. So the managers who manage the fund, they invest the money into corporate bonds, which are taxable, U.S. Treasury bonds, and then mortgage-backed securities and asset-backed securities. So mortgage-backed securities are basically bonds where the income generated from those bonds, they fund mortgages, like your home mortgages or commercial mortgages. So when the people that borrow money for their homes and they pay their regular mortgage payments, the interest on those mortgage payments are squished together and it generates interest income. Are there bond ETFs and regular ETFs? You make it sound like yes. Excellent question, Florence. There are ETFs for bonds. There are also regular ETFs, meaning like ETFs for different stock indexes. There are even ETFs that you could buy for individual stocks too. So I actually buy shares of ETFs every week, like multiple times a week, and of different strategies. So there are ETFs out there for different indexes. So you could buy an ETF for the entire stock market. You could buy ETFs for individual stocks. You could buy ETFs for different types of markets, like foreign markets or commodities, like there's gold ETFs and silver ETFs out there. Silver ones actually have been buying recently. There's an ETF that I'm trading now that is focused solely on South Korea's stock market. So you can get really specific on ETFs. So what's great about ETFs over just individual stocks is that instead of doing your homework on a whole bunch of thousands of individual company stocks, you can just have just a small collection of ETFs that cover or represent many, many stocks all in one basket. So like probably two of the most famous ETFs are SPY, and QQQ. So SPY is the S&P 500. So that's the 500 biggest stocks, and you can just buy it all in one ETF. So SPY. There is the QQQ, which is the NASDAQ 100. So it's the 100 biggest tech stocks. And actually, I'll stick that on the screen so you guys can see them. So there's SPY. And again, not cheap, but if you want to buy, there's other ones out there with probably a little less priced. I think SPS is bigger. There's also QQQ. If you want a basket of the biggest tech stock, the 100 biggest tech stocks, you can just buy an ETF for that. The one I mentioned with South Korea, there's an ETF for that one. So ETFs can represent markets. They can represent different types of assets: gold, silver, copper. There's rare earths ETFs. So it's actually pretty interesting, the diversity. Instead of like shopping for individual stocks, ETFs allow you some flexibility if you want to diversify that way without having like dozens of individual company stocks. You can just buy one ETF that has them all in there. So yeah, that was a great question. Now, PULS and TBLL, so polls and T-bill, basically these two, which I have a lot of my emergency funds in, they invest in solely U.S. Treasuries. So U.S. Treasuries are safe or safer because they're backed by the federal government. And so they're not risk free because there are 10-year treasuries that are, some treasuries are risk free because, and the reason why they're called risk free, which we learn in class, is because if the federal government owes you that money, then they'll just print some more. And that's why they're risk free, because they have the ability to print more cash to pay off these bonds. Because all a bond is the federal government, is you loaning the federal government money, and then eventually they'll pay you back in a few years, or in this case, a year or less. So polls, and PGM is a major firm. They have one that called the Ultra Short Bond Fund ETF. So what they'll do is they'll invest in U.S. Treasury bonds or Treasury bills, and with a maturity of less than 1 year, meaning that they're expected to expire and pay you back in a year. And so, based on what interest rates are doing right now, that's about a 4.02% yield. And I actually looked at that this morning. So this is like super recent. And then T-bill, Invesco short-term Treasury ETFs. So they also invest in U.S. Treasuries with a maximum maturity of 12 months. So these can invest in really short ones. This one about 12 months. So a slightly lower yield. But the reason why I like these, again, they're liquid. So if in case I need the money, I can just sell the shares and get my cash same day. It'll be deposited into my brokerage account. But in the meantime, if I don't need the cash, I'm earning somewhere between 3.5% and 4%, which is still better than my savings account or my money market account. So my money market account is pretty much just a way to preserve the cash I need to pay my monthly credit card bills or whatnot, and that's paying less than 1%. It's not designed for safe income. These are designed for safer income. That one is as well. This one has the highest yield, but that's due to the variety of bonds that they have. Got a question. Are there any penalties when you sell your bond ETFs? No, that's the cool part. So unlike your CDs and money markets, you pay for the bond share price, and as long as they're in a brokerage that doesn't charge you any brokerage fees, when you sell, there's no exit fees either. So no additional fees when you sell the bond ETFs. The only thing, depending on what the bond invests in, if they are like some bonds, if they're in municipal bonds, you won't have to pay taxes. The only catch with these is you might have to pay taxes on the interest, but that's no different than your CDs and money markets, because you gotta pay taxes on that interest as well. But the amount of tax you pay is probably going to be pretty small because you're not really earning that much interest. So the only I call it any tax a penalty because I hate taxes, but yeah, that no penalties in addition. Next time I have regular fee-free brokers. Yes, I'm glad you mentioned that because Robinhood changed the game a few years ago because uh, before Robinhood, there were entities called discount brokerages. And discount, they always considered themselves like the best way to go because there were two classifications. There were discount brokerages and full service brokerages. The discount brokerages basically they execute your trades for you and they charged a little fee. They called them little. Uh, $3.99 a trade or $5.99 a trade, which sounds crazy expensive these days. But then you had full service brokerages, which charged you like, and again, this is back in the day, 15 bucks a trade or 20 bucks a trade. Well, Robinhood came out and says, well, that's not fair. Why should you pay someone else money? Or why aren't you keeping all of your money on your stock investments? And so they said, well, we're not going to charge you anything. And so all of our trades are free. And so when Robinhood came out, and this isn't that long ago, all those quote unquote discount brokerages, they lost thousands and thousands of their clients to Robinhood alone because they couldn't compete with zero commission. So all these companies now had to find creative ways to retain or attract customers without having to rely on income from brokerage fees. And so as soon as Robinhood came out, every single big boy financial institution that had brokerage or trading accounts, they cut their fees to zero. They could not compete. And so that's the industry standard now. So I actually have mine in like 4 different brokerages. I got, of course, my Robinhood account, which is it has a very simple interface, and they pay dividends usually by the same night, which is great. I have a Webull account, has a lot more technical tools, but I really don't use their technical tools. I actually might move money out of that one just because they pay dividends the slowest, but they're also very easy to use on an app. I have a Schwab account, investment account, and I buy a lot of ETFs on there, and I have my emergency funds here in my Schwab account. But the reason why I like Schwab is not only are they fee free, but one of the reasons why I opened the account was actually for the checking account. And the reason, because they have a superior checking account. The brokerage account comes with it for free. So the checking account, as a digital nomad, is elite because it's the only one I know of that doesn't charge international fees, and it doesn't charge ATM fees either. So when I'm needing cash, and cash is king in a lot of countries outside the US, when I'm going to an ATM and they charge like really high ATM fees internationally, like $6 to $8 maybe in some places, Schwab refunds all of your ATM fees for free. So all my ATMs are free when I travel. So they're really good. And then, of course, where I have most of my trading money is in a Tasty Trade account. So Tasty Trade is my favorite because their stock trading, of course, is free, but I primarily use it for my option trades. What's great is that they have the fastest in milliseconds execution, but they also have the best customer service. Their customer service is second to none. I mean, within minutes, if you have a question, they'll answer it with email or direct line. What is really great is that there are no egos, and I met the founders several times at investment conferences. And there's nothing wrong with a lot of the big boy trading firms like TD Ameritrade. What's interesting is the founders of Tasty Trade, they actually invented the platform that Thinkorswim, that TD Ameritrade uses, which I think Schwab now owns. But they sold it for like $700 million. But what they did was they took the engineers that designed it and started their own company and their own financial television network, so which is on every day. And so they came up with a better platform, and that's the one I've been with since. It's been almost 10 years since I've been with Tasty Trade. Well, what's really cool, like I said, with no egos, is that one time a couple of times I had a question about my account, and one of the folks that emailed me back to answer my question was actually one of the on-air talent on the network, and which was really, really cool. And I even, one time I tweeted just an innocuous question about about the CEO who also is on air. And I said, how do I get a hat? Where did he get his cap from? And I tweeted it out to the co-host, and he tweeted me back while he was still on the show, and says, what's your address? I'll mail you one. And I go, that's awesome. But yeah, they're super friendly, and they're down to earth. You would never think that if you ever meet the head of the firm, that he's just walking around. He always walks around in like a t-shirt and jeans, that he's a billionaire. So very, very great company. Again, I'm not paid by them or anything, but I did, just from my own personal experience with both the staff and the professionalism and execution, it's been my favorite brokerage so far. So those are I can only speak to the four I use, but again, do your due diligence. But uh, since I'm a very cheap individual, I always like to not pay when I don't have to. So those are the ones I use that are fee free. So again, Robinhood, I use most. I use Webull. It's more kind of like grandfathered in just because I've been with that one for a while. I think the only reason why I joined Webull is because they were giving me like free stocks for opening up an account. Of course, my Schwab account, and then I have
Question.
my Tasty Trade. Webull. I'm going to type it in the chat box so all you guys can see it. So these are the four that I have. So Schwab, Webull, Robinhood. Again, very simple interface, and then Tasty Trade.
Can you explain a little bit about the wearable technology? Like I
Uh,
mean, like they have the
oh,
analog tool, but
yes. So Robinhood and Webull, those two versus the other two, although I think Schwab has an app too. Those two in particular, when I use those, I actually use the app versus going
uh-huh.
out on the website. So these are downloadable apps, Webull and Schwab. Uh, Tasty Trade, I actually use the web interface for that one, although they do have a web application. And then Schwab, I actually just use the web application, even on my even on my phone. Although I'm aware that they have an app, but I don't haven't really had the need to download that one. But for app usage, I've used the app more on Robinhood and Webull.
So yes, so the question about the app, because I saw they have the analog tool,
Oh, for Robinhood.
the
Oh, for
wearable,
Webull. Oh,
yeah,
so
they have
so
the
they
analog
have.
tool.
Yeah, for that one, again, I haven't really used a lot of the features in Webull, although they have a lot more trading features than
Mm-hmm.
than Robinhood does. Although Robinhood's added a lot recently, which I haven't explored because I haven't really needed to. But Webull does have a lot. What's also great is that they have a lot of Webull in particular has lots of educational resources included with a Webull account, which is kind of nice. A lot of it has to do with trading. So if you're interested in that, Webull is does have that nice feature. But again, I don't use those other than just using it just to buy the shares and hold on.
Mm.
All right. So that's that's pretty much our topic for today. So again, with high yield. So let me go back to the agenda. Before we wrap up our club meeting today, are there any topics that we want to talk about for June's meeting that come to mind?
But so in that in the next meeting, can you explain a little bit about the analog tool in the wearable?
Oh, could you say that one more time? I couldn't hear you on the speaker.
I mean, like in the next meeting, can you explain a little bit about the analyst tool,
Oh, analyst tools.
the analyst?
Um, can you type it in the chat box? That way I'll be able to. I might be able to see it on the chat box.
Yeah, I cannot use the chat feeding
Oh, you can't do the
feature.
chat.
Yeah, I cannot. That's why I have to talk.
Okay, okay. So you said analyst tools?
Mm-hmm.
Oh, okay, like for technical trading.
Yeah,
Yes,
yeah.
actually, I'm going to type that in. So technical trading tools. Yes. We've actually talked about that before, but it's been a long time since we have. So I'm going to type into the chat box so when I review the video later, I'll be able to remind myself that we'll have that for next month. Fun speculation. What uh, if rates drop? Say or say. Oh yeah, that's a good one actually, Florence. I'll actually include that with the what's going on in the market part of the agenda next month. So yeah, what do we think interest rates are going to do? Frankly, it was expected, or IPOs. Oh, we haven't done IPOs in a while either. That's a good one. With interest rates, it was kind of expected that interest rates were going to drop in 2026 because, again, the economy isn't doing that well, and the employment market has been kind of average to below average. So, but the new chairman of the Federal Reserve just took his oath of office last Friday. So we're not sure how he's going to run the Federal Reserve. And there is, with inflation this high, unless something happens, unless the war suddenly ends this week, with inflation being high, I think interest rates might actually stay high for a while. I think the probability that interest rates are going to drop, that probability is going to keep on dropping. So, uh, one of the best ways to combat high inflation is increase interest rates, and no one wants that. So, but of course, the one of the best ways to revive a stagnant economy like what we have now is to lower interest rates. So I don't envy the job of the Federal Reserve chair, because what do you do if we got folks having high inflation? The reason why we actually have inflation instead of 9% like a few years ago, all the way down to under 4, is because we kept interest rates high. But that doesn't help with the markets. It doesn't help with a recession if we're in a recession now. So we have to lower interest rates. But then if you lower interest rates, then inflation goes back up again. So it's a really hard speculation, but interesting speculation, because that can affect your investments. If interest rates go down, stock markets usually like that. Stock markets generally like lower inflation. But the fact that inflation has been high and stock markets are still going up, that's actually been unusual. And so I'd like to still see it go up. Although I have a few trades betting that the market's going to go down too. So it's good to be prepared for both. Yeah, so technical trading tools, interest rate speculation, IPOs, and I'll probably add where to find IPOs too. So yeah, those are awesome topic suggestions for next month. Keep this on your radar in case you hadn't heard of it. You might have heard of the company SpaceX. So Elon Musk's other company, uh, they recently announced that they're going to go IPO next month, and I might pick up a share or two if they go IPO. If I can get my hands on it, it's going to be really popular. But they've officially applied to the SEC to be allowed to start trading public shares in SpaceX, because SpaceX is a private company, so you can't invest in it right now. So once they go public next month, it'll be interesting to see how the stock does. And there's also speculation that they may merge SpaceX and Elon Musk's artificial intelligence company XAI. So if that happens, then that might be the share price might explode. But one thing about IPOs, I'll tell you, since we got a couple minutes to go, is that not all the time, but most of the time, I usually wait for a lot of the hype to die down before I decide to buy shares in an IPO, just because sometimes the price hype drives the stock sky high in the first few days of trading. And I think there was one called Cerberus. That just went public this month. It's another AI company. Well, anyway, when Cerberus came out, the IPO price was like $185 a share, and on the first day of trading, it went up over $300 a share. Now it's actually back down to like 250 a share. So the hype's already dying down. So when you're looking at IPOs, uh, sometimes the hype might die down. I think one of the noted ones that I can remember where stuff was overhyped was when Facebook went public for the first time. Their shares started out at like $30-$40 a share when they sold, but then within a month it was down in the teens because they overestimated the demand for Facebook. They assumed, oh, there's millions of users of Facebook, people want to buy Facebook shares, and nope, not really that many people wanted to buy Facebook shares, so it was down. I actually bought a few, sold it for a small profit and bought something else. But although if you had held shares till now, you would have been happily rewarded because Meta, which is what Facebook is now, is over $600 a share. So not too shabby. All right. Well, if there are no other suggestions, thank you so much for coming. I'm going to email you if you're on the email list. I'll email you a link to the video if you want to watch a video later, and the handouts for today. And then keep an eye out for the next meeting in June. Thank you, everybody.
Thank you and have a good evening.
Yes. Oh, yeah. Those of you that are in my class tonight, I'll see you tonight.